Most real estate investors build linear wealth. They buy properties, collect rent, and hope for appreciation. But there's a completely different game being played at the top. It's called private equity, and it creates generational wealth through multiple income streams and long-term equity control. Generational wealth means wealth you control long-term through equity stakes and multi-income streams. While regular investors earn returns, general partners earn returns plus management fees plus promote. The promote is your share of profits above the preferred return, typically 20% on top of the standard 1 to 2% management fee. After reading the white paper on creating private equity structures written by DeRoos and Bond by NAIOP Research Foundation, I'm going to show you the general partner and limited partner breakdown, how fees and promote actually work, and the preliminary steps to launch your first fund. This will be a summary of their paper. References are in the description. But first, you need to understand the hidden structure that makes this possible. Most people think private equity is just another way to invest in real estate, but there's a secret structure that changes everything about how wealth gets built. The structure has two sides. On one side, you have limited partners. These are the investors who put money into the fund. On the other side, you have general partners. These are the people who run the fund and make the investment decisions. Most investors only know the limited partner side of this equation. Here's what most people don't understand. Limited partners primarily earn through return of capital plus a preferred return on equity before any promote. The word promote is short for promoted interest. It is a special bonus that the person running the fund, called the sponsor, can earn if the fund does well. General partners get returns plus 2 additional income streams that most people never see. They get management fees while the fund operates. They get promote when the fund hits certain return targets. Let me show you exactly where the money comes from and where it goes. When you raise a fund, you collect money from limited partners. Let's say you raise $20 million. That money goes into a capital stack. The fund uses this money to buy properties. The properties generate rental income. The fund also sells properties over time. All of this money flows back through the capital stack. Limited partners get their money back first, then they get their preferred return, usually 6 to 8%. After that, the general partners start getting their promote. This is completely different from joint ventures, family deals, and REITs. Unlike a joint venture where each dollar is equal, private equity uses a waterfall structure so sponsors can align incentives through promote. A waterfall is the order in which profits get shared between the investors and the fund manager. In family deals, you usually just split everything evenly. REITs pay dividends to shareholders, but you don't control the properties or the strategy. With private equity, the general partners control everything and get paid multiple ways. Be sure that you find a lawyer that is familiar with private equity so that they can set up the legal structure correctly. Many funds are regulated by your region's Securities Commission. Typically, your lawyer will create a limited partnership or LLC, write an offering memorandum that explains the fund strategy. Investors sign subscription agreements. The structure protects both sides because everything is documented and regulated. Being on the general partner side changes your wealth-building timeline. Instead of waiting years for property appreciation, you start earning management fees immediately. These fees are usually 1 to 2% of the fund size annually. On a $20 million fund, that's $200,000 to $400,000 per year, just for managing the fund. The promote kicks in when the fund hits its preferred return targets. This is usually 20 to 30% of the profits above the preferred return. If the fund generates $10 million in profits above the preferred return, the general partners get $2 to $3 million. That's on top of their management fees and their own investment returns. Here's the real difference between building wealth as a limited partner versus a general partner. Limited partners get their returns, but general partners get returns plus management fees plus promote. A limited partner might earn 8% returns. The question becomes, how does someone without experience actually get into this position? You need a track record to get investors, but you need investors to build your track record. Here's how Nair cracked it, a real estate fund based out in the US. This is the main barrier when you're starting your first fund with limited experience. You can't get investors without proven results. You can't get proven results without investors. Most people give up right here. Even experienced real estate investors struggle with this transition because private equity requires different credibility markers. You might have bought 50 rental properties. You might have flipped hundreds of houses. But private equity investors look for different things. They want to see fund management experience. They want to see how you handle other people's money. They want to see your investment committee process and formal private placement memorandum. These are completely different skills from buying properties with your own money. Nair Properties shows exactly how to solve this problem. Dan Nair started his first fund in 2009 during the worst recession in decades. Banks weren't lending, joint venture partners were scared, traditional funding sources had dried up, the worst possible time to raise money. But Nair Properties raised 4 funds totaling $60 million between 2009 and 2014. They grew from $100 million in assets to over $500 million. 85 properties across 4 states. Here's their exact approach to building credibility without a private equity track record. They focused on their real estate experience, not their fund experience. Nair Properties had been in business since 1995. They had a long track record of commercial development and construction. They knew how to assess risk. They knew how to execute deals. They used this foundation to build investor confidence. The relationship-building process happened before they ever asked for money. They didn't send cold emails to investors. They partnered with financial advisors who aggregated smaller clients into the $200,000 minimum using local service firm referrals. They built relationships first, then presented opportunities. Their offering memorandum focused on what investors actually look for in new general partners. They highlighted their track record with previous successful deals. They showed examples of properties they had bought, improved, and sold. They explained their investment process step by step. They proved they could execute the strategy even without fund experience. Starting small with a $20 to $50 million fund was actually an advantage, not a limitation. Their third fund had a $25 million raise with a $200,000 minimum commitment from accredited investors. They targeted accredited high net worth investors in their local market. Smaller funds are easier to fill. Local investors are easier to reach. You can build personal relationships with each investor. Another way to get started can be to focus on the deal first. Find the property, structure the deal accordingly, and present it to family and friends. Get their feedback and adjust your structure based on their comments. Do all of this before spending money on legal fees. You might not end up closing on the first deal, but after pitching several potential deals to them, you may start to get an idea of what your investors are looking for, then double down on it. The specific strategies that work for first-time fund managers come down to 3 things. First, keep the structure simple. Don't overcomplicate the return waterfall. Don't create complex fee structures. Make it easy for investors to understand what they're getting. Second, co-invest your own money. Nair Properties invested at least 10% of each fund. This shows investors you have skin in the game. Third, align your interests with investor interests. Nair Properties took an 8 to 10% preferred return for investors before they got their promote. Focus on your real estate track record, start with relationships, not cold outreach, and create a simple fund strategy that investors can easily understand. The credibility problem isn't about your experience. It's about how you present your experience and who you present it to. But here's what makes being a general partner truly different from any other real estate investment strategy. General partners earn money through 2 core income streams that work simultaneously throughout the fund's life cycle. Most people think you need to choose between steady income and big returns, but general partners get both at the same time. Management fees provide the steady income stream that starts immediately when the fund launches. These fees are usually 1 to 2% of the fund size annually. On a $20 million fund, that's $200,000 to $400,000 per year. The fund pays these fees whether the properties make money or not. You get paid for managing the fund, finding deals, and overseeing operations. This creates steady cash flow while you wait for the properties to appreciate. The promoted interest system determines how profits get split between limited partners and general partners after the preferred return is met. First, investors get their capital back, then they get their preferred return, usually 8%. After that, the general partners start getting their promote, which is typically 20% of the profits above the preferred return. Let me show you how this works with real numbers. Take a $20 million industrial facility. To simplify things, we will ignore the complexities of a typical fund and let's assume that everyone gets paid at the end of the project. Here, the sponsor invests 20% of the equity. Limited partners invest the remaining 80%. The limited partners and sponsors share net proceeds in an 80-20 ratio until both have achieved an 8% IRR and return of their capital. IRR stands for internal rate of return. It's a way to measure how much money an investment earns over time. It's usually shown as a percentage, kind of like interest on your savings account, but for an investment. Once limited partners achieve their preferred return, the sponsor gets promoted interest on additional profits. The sponsor also takes fees, which are deducted before cash flows are distributed. These fees include a fundraising fee of 1% of equity raised, a management fee of 1% of equity raised annually, and a disposition fee of 0.5% of the net sales price. When fees are included, the sponsor's return jumps to 25.3%, while investors earn a 14.2% IRR. In this example, the sponsor's equity investment is reduced from $6 million to $1.2 million for the same $20 million property investment. The sponsor's equity IRR changes from 16.9% to 15.1% after fees, but the equity multiple increases to 1.84 times due to the promote structure and fee income. These streams compound across multiple funds. Your first fund establishes credibility, your second fund gets bigger, your third fund attracts institutional investors. Each fund builds on the success of the previous one. Management fees grow with fund size, promote percentages often increase with track record. The income streams work together to create generational wealth because they're repeatable and scalable. But understanding the structure is only the beginning. The execution comes down to 5 specific steps that anyone can follow. The complete roadmap from idea to launched fund is straightforward. Most people get overwhelmed by the complexity, but successful fund managers focus on simplicity. They break everything down into clear steps and execute them one at a time. Step 1 is defining your fund strategy. You need to choose between core, value-add, opportunity, or distressed debt strategies. This choice determines everything else about your fund. Core strategies focus on stabilized properties with steady cash flow. Value-add strategies target properties that need improvements to increase value. Opportunity strategies look for distressed properties or market dislocations. Your strategy should align with your expertise and market opportunities. The chosen strategy dictates the fund's risk profile and potential returns. Step 2 involves fund formation basics, including legal structure and offering memorandum creation. You structure it with a general partner and limited partners. The GP creates the fund and solicits equity investments from LPs. The offering memorandum communicates the opportunity to investors and protects the sponsor from liability. While a formal offering memorandum is not always required for smaller offerings, it is essential for larger offerings to effectively communicate the rewards and risks of investing. Organizational costs for a first fund are around $400,000, with minimum fund size typically $20 million according to NAIOP Research Foundation. Step 3 is attracting limited partners through relationship building and credibility establishment. You leverage your existing relationships, credibility, and track record to attract investors. Even if starting small, a strong reputation and a history of successful real estate deals can be leveraged. Target investors through professional networks and connections with professional service firms. The Nair Properties case study demonstrates the importance of a sponsor's track record and reputation in raising capital. They worked through professional networks rather than cold outreach. Sponsors often waive fundraising fees in their first fund to attract LPs, though these fees typically range from 0.5% to 2%. Step 4 involves structuring fees and alignment to ensure you get paid while delivering returns. You carefully consider your compensation, which typically comes from a promoted interest and various fee. The promote consists of a percentage of the profits of the fund. Again, management fees typically run at 1 to 2% of assets under management. Acquisition and disposition fees range from 0.5% to 1%. Align interests with investors through co-investment, where the sponsor invests a portion of their own capital. This demonstrates commitment and builds trust. Step 5 is setting up governance and reporting systems that build trust and create repeat investors. You provide a governance structure that aligns with ILPA principles, including advisory committees, strong clawback rights, and regular transparent financial reporting. The governance structure should address the team, investment strategy, fiduciary duty, changes to the fund, and the embrace of an LP advisory committee. Success comes from starting simple, building trust through transparency, and focusing on delivering results rather than complicated strategies. Your first fund doesn't need to be the biggest or most complex. It needs to deliver returns and build relationships that create the foundation for everything that follows. The shift from being a real estate investor to becoming a capital allocator is the difference between building wealth and building legacy wealth that lasts generations. Most people stay stuck in linear wealth building because they don't know this path exists. But now you have the roadmap to change your family's financial future. Start exploring this path, even on a small scale. Again, your first fund doesn't need to be perfect, it just needs to begin the process of building generational wealth. Even smaller sponsors have raised $50 to $150 million funds, proving that mid-size funds create real opportunities. This is your blueprint. The next step is to apply one of the 5 fund strategies in your market. I am still learning everything I can about fund structures, so if there is anything I described incorrectly, please beg my pardon. This is just a summary of the white paper I have reviewed. Also, a real estate transaction usually consists of some form of financing. If you want to learn about how real estate is financed on the inside level, be sure to watch my next video on how mortgage investment corporations work.